Objective number 1 was the purchase of inventory. Now we're going to discuss the sale of inventory in objective number 2. Okay, the sale of inventory. First time we're seeing this account. Sales revenue. It's the amount earned from selling our inventory. Sales revenue, as you can see, is a revenue account. Also associated with the sale of inventory is the cost of goods sold. The cost of goods sold is the cost of the inventory that has been sold to the customers. This is an expense account. So what does this mean? Okay, sales revenue and cost of goods sold. Sales revenue is the amount you earn from selling an item. Okay, you sell me an item for $100. As a merchandiser, you want to know how much that item that you sold me cost you, the merchandiser. If you bought the item for $40, that's your cost of goods sold. You turn around and sell it to me for $100, that's your sales revenue. Okay? So as a merchandiser, you're tracking not only what you sell, but also the cost of what you sold. What you sold was $100, something for $100. What it cost you was $40. Okay? So, looking at sales transaction on slide 22. Sales returns and allowances is when a customer returns goods or the seller grants a reduction in price to the customer. This account is a contra revenue account, means it has a debit balance. We've got that term contra in front of revenue. That means it's got a balance opposite of its normal balance. So since a revenue normally has a credit balance, a contra revenue would have a debit balance. A sales discount is also a contra revenue account with a debit balance if a customer pays within the discount period allowed by the seller. And of course, we talked about delivery expense earlier. This is known as freight out. Okay, so let's see how we would record sales transactions. Looking at S5-5, page 284. Now, this is one of my favorite problems. Okay, Tommy sells $60,000 of women's sportswear to a Target store under the credit terms of $210 net $30. His cost of the goods is $32,000, and he collects the cash from Target on the 10th day. Journalize Tommy's sale, cost of goods sold, and the cash receipt. Okay, why it's my favorite problem? Here's a guy pulling up to a Target and selling $60,000 worth of women's sportswear. Really, I mean, they use large buyers, so this situation would never happen, but that's just funny. So, how do we record the transactions? Tommy sells the goods to Target on account. So he's going to debit accounts receivable for $60,000, credit the sales revenue for $60,000. Okay? Also, when you make a sale, not only do you record the sales revenue entry like we just did, you also record the cost of goods sold. The cost of goods sold, they told us, was $32,000. So we debit the cost of goods sold, we credit the inventory. This transfers the inventory from the balance sheet over to the income statement under cost of goods sold. So every time we make a sale, we need to record 1 for the revenue and 2 for the cost of goods sold. Okay? So, let's see. If there were no credit terms allowed, Tommy would debit the cash and credit the accounts receivable for the full amount where there is no credit terms allowed. Or if Target paid after the discount period. Okay? So, what happens when Target pays within the discount period? Step number 1 is to credit accounts receivable for the full amount. Step number 2 is to calculate how much cash Tommy will receive. The credit terms were 2% if paid within 10 days. So you take 100% minus 2%, that gives you 98%, times $60,000, that gives you $58,800 cash that Tommy will receive. The difference is you take the cash and subtract it from the receivable of $60,000. That will give you your sales discount of $1,200. Debit the sales discount. Your journal entry is now in balance. Collect it on account. So the sales of $60,000 less the $1,200 will give you $58,800. Okay? Hopefully you did well with that one. Next we've got Amazon.com, and they've got some book transactions. So let's pay attention to this one because there's some facts that you really have to read into this. Suppose Amazon sells 1,000 books on account for $10 each. The cost of these books was $6,000. So we have our sales price, we've got our cost of goods sold. 100 of these books with a cost of $600 were damaged in shipment, so Amazon later received the damaged goods as a sales return. So we have the sales, we have a return. Then the customer paid the balance within the discount period where the credit terms were $215 net $30. So let's journalize the sale. We're going to debit the accounts receivable for $10,000. We're going to credit the sales revenue for $10,000. The explanation is to record the sales on account. Sale, we said in our last example, every time you make a sale, you've got 2 journal entries, one for the sale and one for the cost of goods sold. The cost of goods sold in this example were $6,000. So we'll debit the $6,000, we'll credit the inventory for $6,000. Just as we have 2 entries when merchandise is purchased, we have 2 entries when it is returned. So Amazon took back 100 books at $10 each. So we'll multiply 100 times 10 and come up with a sales return allowance of 1,000. We said sales returns and allowances was a contra revenue account, so we have to debit that account. What's the account we're going to credit? We're going to credit the receivable. Amazon is no longer owed $10,000, it's only owed $9,000 because we took back the $1,000 in returns. Second part of the return entry would be a debit to the inventory, a credit to the cost of goods sold. Just the opposite of our original entry, $600. Okay? Slide 29 shows us how the T accounts will look after the returns. And then next, we want to record the payment to Amazon within the discount period. So number 1, you're going to credit accounts receivable for the full amount, $9,000. Next, we're going to calculate the cash proceeds. The credit terms that were given to us were 2-15. So 100% less 2%, 98% of $9,000 gives us $88.20 as the cash proceeds. 9,000 less the $88.20 gives us a sales discount of $180 collected on account. So slide 31 shows us the T accounts after we journalize the transactions. Okay, and then 5-7 says use the data from 5-6 to compute the net sales revenue and the gross profit. Okay, gross profit is net sales minus cost of goods sold. Okay, so net sales is equal to the sales less returns and allowances less discounts. So the first thing we do is we calculate our net sales. Sales less returns and allowances less discounts, $88.20 net sales. Cost of goods sold, $5,400. Okay, pulling these numbers right from the T accounts on slide 31. Net sales of $88.20 less cost of goods sold of $5,400 gives you a gross profit of $34.20. So net sales less cost of goods sold equals your gross profit. Okay? Net sales less cost of goods sold equals your gross profit. So the thing to remember from this objective is that I would walk away from it is that every time I make a sale, I've got to make two journal entries, one for the sale, one for the cost of goods sold. Every time I have a return, I've got to make two journal entries again. One to book the returns and allowance, one to adjust the inventory. And lastly, I really need to know this formula for calculating gross profit. Net sales minus the cost of goods sold equals your gross profit. Also, net sales is equal to your sales minus your returns and allowances minus your sales discounts. Okay, so that's objective number 2 in chapter 5.